Okay,
You
let's
know,
hear.
we spend so much time, maybe all our time, figuring out when to buy, when to get into a trade. But here's the thing the pros know. The real key to performance, the thing that truly matters, it's all about knowing when to get out. So today, we're going to do just that. We are building your financial parachute, a solid, multi layered exit strategy. And this quote, man, it just hits the nail on the head. Exits make the trade. Think about it. Clicking the buy button is the easy part. Anybody can do that. But how and when you decide to exit, that defines everything. It defines your gains, your consistency, and your ability to stick around in this game. It's not about the entry signal, it's about having a solid exit architecture. And that brings us to the big question, doesn't it? Have you packed your parachute? I mean, it's the perfect metaphor. You would never, ever jump out of a plane without triple checking your parachute. So, why on earth would you jump into a trade without a rock solid exit plan? It's the same exact principle. So, let's get to it. Let's build this thing together, piece by piece. Okay, so where do we even begin? Well, every good parachute needs a strong, reliable core, right? The main structure. In trading, your core is all about the fundamental rules you set before you even think about putting on a trade. Let's break down those main components. And here they are, the stop loss and the profit target. Now, a huge mistake people make is thinking of these as two totally separate ideas. They're not. They're two parts of the exact same system. Your stop loss, that's your safety net. It's you ahead of time deciding the absolute most you're willing to lose on this idea. And your profit target, that's your finish line. It's your disciplined plan to actually take your wins off the table. You absolutely need both to build the basic frame of any trade. And this is where the magic really happens. This is the secret weapon for so many profitable traders, the asymmetric risk to reward ratio. The idea is simple, but oh man, it is powerful. You aim to make at least 3 times more on your winners than you risk on your losers. So for every $1 you're willing to risk, you're shooting for $3 in potential profit. This one rule changes the entire game psychologically. And here's what that looks like in practice. Let's say you risk 5% on a trade. That's where your stop loss is. Well, with a 1 to 3 ratio, your profit target would be all the way up at 15%. Now, here's the incredible part. With a setup like this, you can be wrong more often than you're right and still be profitable. Seriously, the math is just on your side. Your winners are so much bigger than your losers that they more than make up for them. And that takes a ton of emotional pressure off, you know? You don't have to be perfect. All right, so we've built the core of our parachute. The main structure is there. Now it's time to add the safety features. These are the dynamic moves you make after you've jumped, while the trade is live, to protect your capital and your profits. And the first one, oh, this is a game changer for your peace of mind. It's called the break even stop. The concept is so simple, it's just beautiful. Once your trade has moved in your favor, you're in the green, you just slide your stop loss up to the exact price you got in at. And just like that, poof, the risk is gone. You literally cannot lose your initial capital on the trade anymore. It's all potential upside from there. So, how do you do it? It's just 3 simple steps. The trade goes green, you move the stop to your entry, and your capital is safe. But, and this is a really important but, you have to know what this tool is for. It's a defensive move. It's about protecting your capital, not necessarily maximizing your profit. Sometimes, if the market gets a little choppy, you might get stopped out for no gain, right before it makes the real move. It's a trade off, you see. You're choosing safety over trying to capture every last penny. Okay, what if you're sitting on a really substantial gain? Then you can bring out some more advanced tools, tactical hedges. Just think of it like buying insurance for your profits. You could use things like options. Put options go up in value if your stock goes down. You could use inverse ETFs to protect against a broader market tip. Or, hey, the simplest hedge of all is just to sell a piece of your position. But here's the golden rule you have to remember. Hedging isn't free. You only do it when you genuinely believe the risk of giving back your gains is bigger than the potential for even more upside. All right, we have our core structure and our safety features. Now it's time for the advanced navigation, the smart overlays. Think of this like adding extra layers of information to your map, things like taxes and major market events that can totally change the terrain. Let's talk about taxes. I know it's not the sexiest topic, but it can be the silent killer of your returns or a silent driver if you do it right. Your exit plan is simply incomplete if you don't think about them, and it really breaks down into 3 phases. First, allocation. Where you hold the trade, like in a tax-advantaged account, matters a ton. Second, strategy. If you're trading really frequently, you want to do that in a sheltered account.
And third is timing. Just deciding when to sell can make a huge difference to your final tax bill.
And then there are events. Markets run on stories, on news, on big catalysts. A smart exit plan doesn't just react to these things, it anticipates them. You've got a stock that has soared right before its earnings report. Maybe it's smart to take some profit off the table. Is there a big central bank decision coming up? Maybe you tighten your stops. The whole point is to get ahead of the volatility curve, not just get tossed around by it. Okay, let's pull all of these threads together. We've designed and built all the different pieces of our parachute. So now it's time to create that final pre-flight checklist, the one you run through every single time before you jump. And here it is, your 5-point exit plan. This is non-negotiable. You have to have an answer for every one of these 5 things before you put a single dollar at risk. Number 1, a defined stop loss. 2, a clear profit target. 3, a plan for how you'll protect profits. 4, a backup plan for market events or crazy volatility. Then 5, a tax-smart timeline. This is what turns a complex idea into systematic, repeatable execution. This right here, this is your parachute. So the plan is ready. But that leads to the final and maybe the most important question of all. Are you prepared to pull the cord? Because having a plan is one thing, but having the discipline to follow it, to pull that cord when your rules tell you to, without emotion, without hesitation, that is what truly defines success. Your parachute is packed. The only real question left is, will you trust it?
Okay, so we have looked at the different problems that you have to face, and let's again look into of our slides. Okay. First of all, we need to remember that indeed the way to preserve our to think about our gains and losses is in fact that we need to preserve our gains. So basically, if we have the gains like we have in our US portfolio, we have a very extremely good run last year, so we have significant gains. So we should now think twice how we should defend our gains. So the first thing is how to defend our gains, and we have already shown to you that we can look at both the winners and the losers. So that's the basic thing, is that we should look at both the winners and the losers, and then we need to define a protection strategy that may involve hedging, which, let me just explain to you briefly what we mean by hedging, that somehow we don't need to touch your portfolio at all. You just need to take positions in other assets, namely derivatives and so on, that will move contrary to your position. So if you are afraid of having a loss, you will try to find and to take a position on an asset that will increase when yours is declining, and so that's called hedging. And then at the end of the day, you also need to take into account taxes. Taxes are always with us. We can't avoid them. That's unfortunate, but that's how it is. Okay, so we need then a philosophy of how to defend our gains, and that philosophy may rely on what we said here, was having some kind of risk-reward ratio that we try to keep. And how do we set a real risk-reward ratio that we want to do? Very often it's very simple. We just need to look at the historical volatility of our stock. Let's go to our platform here and see how we could do that by looking, for instance, at our Microsoft stock we have here. And so remember that we entered in August we entered our trading in August last year. So let's look at Microsoft on that date. That's the beautiful thing about this. Sorry, I'm not on the right. Yeah, we shall go to analysis. Then I enter here Microsoft. Okay, but now I'm going to choose a date last year. So you see what I'm going to do here is go back to last year, to August, and we decide to enter on the 8th. Probably we decide that on the 7th. So let's see how it was, what kind of information I would have by then. And what led us to, okay, let me see. We have here, okay. Okay, so in that period of during that period when I was looking at this, when we were looking at the stock, you see it seemed quite good because it had was trading at 520. We had a stock price target of 685. It had a very good positive increases in the in the past. So basically, we had no on a 20-day period, the stock hadn't changed that much. I think I have some problem here because this was supposed to allow me to change the period rather than having a fixed interval here. Maybe I'm doing something wrong here, or I'm confused about the platform. But anyway, let's look at the 20-day period. So the stock seemed to be quite all right, you see, because so there was a problem with this stock on that date. It seems to be reasonably attractive. So no history of negative returns on over a period of 20 days from June to August. So it was the last quarter. Maybe if I go back a little bit, I can try to go back a little bit, and let's say I go back 3 months to confirm if it was like that. Oops, I need to go back on this one as well. 1, 2, 3. Okay. And let's see how it looks in the past. So if I had looked into the past, so you see, I was looking at just at the 3 months. So at the 3 months, in a 3-month period, in that recent period, really the stock was doing quite well. So it was doing quite well. It had always shown positive returns. But now if I had gone back 3 more months, then what I would see that, in fact, the stock had been periods where they had lost almost 7%, 3% here. So it was not doing that well. So in fact, I should have look at a longer period of time before I felt so confidently that the stock was a winner. And if I go even back, probably I would get a different picture. So let's remind that when we try to, so if I was, for instance, look at this example that we have here. If I was looking at this period, I would set, say, a minus, whatever it say. I would have looking at a risk-reward ratio of -7 and a positive what? 20%. Okay. So what would be the kind of reward that I would expect here? It's a 1 to 3 reward. So right, because 3 times 7 would be 21. So it's approximately 1 to 3. So it's a reasonable risk-reward ratio for me. Yeah, maybe it's within a reasonable amount. So for I'm willing to lose 7% if my prospects of winning are 20%. So it's 1 to 3 more or less. Seems to be okay. But could this risk-reward ratio still be the same on a period on a longer period of time? Well, I can again go back another 3 months and check if it's still reasonable. And I'm going to back to 3 and go back another 3 here. Okay, let me see what it was like in the period before. Okay, now what I have in the past, you see, I have a different picture here, because in the past, if I look before that, I had a -7 and what is it? Plus 3.6. Well, let's say 4. Okay, so here the ratio is really well below 1. So you see the ratio would be below 1. And so would I be tempted to invest on this stock based on this risk-reward ratio? Certainly not. So if I was looking at another 3 months before that, I would be looking. So when I want to use indicators like these ones, for instance, I have to bear in mind that I should need to have a reasonable long period of time and see how they evolve and make sure that the stock is really worthwhile in terms of my risk-reward criteria. So this is one of the criteria that we can use. Okay, let's continue with a few more topics on this. What do we need here? Well, let's go to our presentation and have a look at the hedging issue, whether we should use hedging or not. I'm not sure it's here. Actually, let me remind you that in the case of stocks like Microsoft, we have the possibility of using some interesting instruments like single stock futures. There are future contracts for a stock like Microsoft, not for the smaller stocks, of course. But that means, does that mean that I should jump instead of touching by using my instead of using instead of selling Microsoft, should I try to protect the Microsoft with other with some future contracts? It's probably not. It's not easy. Why it is not easy? Because typically the futures for single stocks futures are very the trading is very thin, so they are easily manipulated. They change. They are quite volatile as well. So it might be very risky to opt for this type of protection. Shall I go for an index, for instance? Then there you have a better protection because the market is more liquid. But again, the problem is that you need to make sure and to be sure that the correlation between your instrument, let's say between Microsoft and whatever instrument you're going to use to hedge your Microsoft position, is really a stable correlation, and it's a high correlation and a stable correlation. Okay, high correlation, you may find the number of instruments that are probably highly correlated with in a negative way. That would be your case. With Microsoft, the problem is that correlations again are very volatile, so change quite a lot. So the fact that a given instrument could be strongly correlated with negatively correlated with Microsoft doesn't mean that it will last long enough to protect you. So it's a bit of a difficult strategy, the idea of trying to protect your losing positions with derivatives. It's a bit of a risky position, but it doesn't mean that you can't use, of course, if you are willing to risk that. But you should be aware that what is your relative risk with because in the end of the day, protection is not free, so you can take insurance without paying your premium. And in this case, the premium may be quite high and not be worthwhile the insurance that you get. Okay, finally, looking at event-driven exits, which is also an important issue. Those event-driven issues, for that you need to also again to look at which events really are important for your stock. So is your stock very sensitive to, say, earnings releases? Is it very sensitive to research reports? For instance, it's very sensitive to that. It's very sensitive to some kind of news. Is it very sensitive to the general volatility in the market measured by indicators like the VIX index and so on? So you have to find those events or changes, potential events that may eventually affect strongly your stock. If they don't affect your stock, so it's no point trying to find those events that and take into account those events. Again, it's a bit of experience. You need to learn through the years to see or to try to figure out which events have really some impact on your portfolio and specifically on your stocks. Okay, finally, let's look at our platform again, because we have a very important tool that you should be aware of, and it's here in our evaluation section. We'll explain it in more detail in the forthcoming sessions, but we want to something that you should always keep into account is that you should always keep track of how much losses have you taken during your latest trades. So, for instance, here we have, as you can see, our total losses are quite significant. We have here 250 in accumulated 250 in realized losses. Now, what we should look next is then to what is our realized gains. And then we have here that we have another $123,000 of unrealized losses. Okay, so both together we have 200, 150, well, 300, almost 400 in losses. Okay, but if we look here, we have 2.6 million. No, sorry, return current. No, not the value. I'm mixing return with value. I'm sorry. So we have here 810,000 unrealized gains. So we have 400 unrealized losses, and let's say we have 800 unrealized gains. Okay, shall we cover those? Okay, that's something that you can, of course, decide by selling some of your remaining losing stocks and some of the winning stocks. And this is when you come to a very interesting position, which is looking at the you remember in the presentation we were talking about how to look at our at the portfolio. We had alerts for big losses, big gains, but we didn't have alerts for stocks that are stagnating in this, let's say, minus 10 and minus plus 10 and minus 10. So if you have stocks that are sort of staying here for a long time, so this is the time to manage to look at these stocks so that in the end you take use your capital losses to offset some of your capital gains. And this is the ideal decision, which is to look at those stocks that are sort of stagnating in this range of -5 + 5 or -10 + 10. And these are the ones that you need to manage, not on a daily basis, but at least once a year, or maybe even every half a year. You should look at this carefully, and then manage this position in terms of losses and gains, so that you keep your portfolio with more with a better composition, and increasing the ones that are well above the market, and not those that are incurring substantial losses. So this is the main recommendation that I would like to give you, is that at least once a year, and that's why it's important to have a calendar in your mind. Once a year, at least look at these realized and unrealized gains, and then manage this part of your portfolio to do what? To have some kind of tax planning. And of course, here you need to take into account the specific regulations in your country concerning what's called wash sales, which are sales, temporary sales to take advantage of the capital gains taxation. Okay, so so far we have come to then look at how we should combine profit taking and stop losses in the same evaluation.